All right, everybody, what is going on? It's Thursday at 11 Central, which means it's Beyond Stocks time. And I'm super excited to have my friend and colleague, Mr. Jared Benson, on. And he's going to have some great stories and background to share with us. So I'm excited to get into it. Want to take a moment to thank our generous sponsor. Without him, the show isn't possible. And that, of course, is Vince Porter, my business and personal accountant. So this episode is sponsored by his company, Porter and Company CPAs. And whether you're leading a deal as a general partner or you're investing passively, you need an accountant who specializes in private offerings and knows how to do partnership taxation. And so Vince is my man for that. So please contact him to learn more at mytexascpa.com. All right, Jared, thank you for spending time with us. Welcome to the show.
Yeah, dude, I'm excited to be here. This will be my first live show to be on. I've done some recorded ones in the past, but let's hope I don't really fumble the football on this one. So, but also man, I love that you have a CPA who's, that you can connect people with, because what a lot of people don't realize is that most CPAs are tax preparers, right?
Yeah.
They just file your taxes and tell you what you owe. So you really need someone like Vince that you just mentioned, who knows what they're doing, especially if you are getting into anything other than just a W-2 income.
Totally. And you know that because you do offerings and you invest as an LP, as I do.
And I'm a small business owner,
Yes. The analogy that I use with accountants is you wouldn't go to a neurologist if you have an ankle sprain. Doctors are specialized and so are accountants. So if you're going to be doing deals, private deals, you need the right accountant.
Absolutely.
Yeah. So, Jared, tell our audience about your background. How did you tell us a little bit about your journey, how you ended up being an investor as you are today?
Yeah, man, it's I say kind of interesting. I think it's really just because it's kind of normal. It's I didn't grow up like some of these guys on YouTube where my dad was a hedge fund manager and I'm really bootstrapping. It's no, your dad was a billionaire. I was, but I also didn't I wasn't this huge executive that just moved over to doing my own smaller version of this giant company I was running. So I've always worked for small businesses. My dad was actually a CPA who had his own small CPA firm. So the kind of the self-employed model was kind of what I always had in my head. Didn't know what that looked like. And, shortly out of college, got married, started working for a small construction company. I say kind of family owned, but the guy who owned it didn't have a family. So it was just a dude who owned it. And, but worked for a small construction company. And my dad at the time was hey, have you heard these guys on the radio? And it ended up being Lifestyles Unlimited. So that was my introduction to investing, which I think a lot of people, that's their introduction, is something like that. I read the Rich Dad Poor Dad by Robert Kiyosaki, might be the pivotal thing that said, oh, real estate is what I should do. And then it was, okay, well, I found someone to teach me a little bit more. And that was in the Dallas area, Lifestyles Unlimited. There's still a big education. You might put them in the guru category. They provide good content. But I worked for a small business. I didn't have any retirement accounts. It was basically just doing my own thing. And that's where now I'm rambling, but the question was how did I get into passive investing? Is that right?
Yeah.
Okay.
Well, I gather now, I didn't realize you were a member of Lifestyles Unlimited, but I gather that that's probably.
I was actually never a member. I just went to the 2-day education seminar.
I see.
And was okay, well, I don't have and I was 23 or something when I went. So I didn't have the capital to join their private program, this and that, but I was okay, I know what I can do. So then it was Bigger Pockets. I consumed Bigger Pockets podcasts. the original, Brandon Turner and whoever the other original host was. I mean, just every
Scott
day I'd go
Trench, I
on.
think was his name, if I
Who?
remember correctly. Scott Trench.
Oh man, I can't even remember. I mean,
That's just the
it's
name that
been
came to mind. I might be 100% wrong. Leave us a comment if
yeah, leave a comment
letting
if
me
you know
know.
who those original guys were, but this would have been over a decade ago. And so just consumed content, um, and ended up the first group I actually joined was a Sumrock group, the Brad Sumrock, multifamily investing group. So I
Uh-huh.
made my very first passive investment into a multifamily syndication in 2015.
Got it.
I was 25 years old and I could barely afford half the minimum they were trying to raise, but they let me invest at $25,000 anyways. So
Got it.
uh, that was my very first time, and that was kind of if you have anybody who's newer to alternative investing or considering it, that first time you wire 25, 50, $100,000 is kind
Scary.
of like scary. Yeah,
Yeah.
yeah.
So I learned a couple things about you because I've known you for a few years, but didn't realize that you were involved in those two mentorship groups. So for our audience, particularly Dallas, but this was a nationwide phenomenon, really,
Mhm.
where multifamily or real estate mentorship groups would coach you, teach you how to invest, put you into a community that helps lead you along, helps teach you, and then and brings you deals as well. So you mentioned Lifestyles Unlimited is
Yep.
a very long-standing group, especially here in Texas. And then Brad Sumrock is a multifamily
And he came
coach.
out of the lifestyles. I think he was one of their first like lead mentors or something.
That's correct. Yes. And so he has a huge presence nationally, but also particularly in
Yeah.
Dallas, where I believe Brad lives. So I came out of a multifamily mentorship group myself, which is in turn an offshoot of Brad Sumrock. There's a guy named Mark Kenny who
Yes.
created a group called Think Multifamily, and I was in that for 2 years, and that helped me learn the ropes and do my first
Yep.
multifamily deal. But in any case, uh, these coaching groups, or the pejorative way to say these guru groups, they exist. They can
Yeah.
be very helpful to you as you are trying to navigate the alternative investment space.
Absolutely. Yeah.
Yeah,
I mean, sometimes it's just a great way to get that concentrated education to know, do I want to do this or do I not want to do this?
yeah.
So at a
And
minimum, they can provide that content.
absolutely. And what I found very valuable about being in a group like that was I'm surrounded by a bunch of people who are kind of similar to me. I was a corporate guy,
Uh-huh.
and there's other corporate guys and corporate women who want to do a multifamily deal. And so
Yep.
it's kind of inspirational, grinding together as part of a community. So how many multifamily deals did you end up doing as a limited partner?
Man, I've actually only ever done 2 multifamily specific deals.
Got it.
Um, and the reason for that, which, I think might be of note related to, the audience or, how do you get to invest in these things, was that at the time I invested, um, I was not an accredited investor. So I didn't meet any standard related to my income or wealth at the age of 25 to invest in these types of deals. And so like you said, one of the benefits of these types of groups is um, getting to invest in slightly different versions of what an accredited investor can participate in. Like there's a separate category, right, that allows the lead sponsors to raise money from a separate category called sophisticated investors, meaning people who've done enough education that they should reasonably be able to make their own financial decisions, even if they don't meet financial standards, which is what it takes with an accredited investor. So I was 25, but I was able to say, hey, I've been to all these seminars, all these education stuff. I think I'm sophisticated. And those groups create these pre-existing or long-standing relationships, right, with the sponsors and these passive investors. And so the IRS allows for people younger or who don't have a ton of income, I say a ton, hundreds of thousands of dollars in income, to invest in these deals. So I did that in 2015. I made a career shift. I got into real estate as a career. Uh, I'm a real estate broker now. And so then there was a number of years where like, okay, I had quit my job, restarting, trying to grow my income back up. So I even had investable cash. Right. And so it took a few years to get that way. And then some of my other investments, not that I've only done two syndications. I've just invested in, a title company, a manufacturing business, a pharmaceutical business, other stuff. And now I do qualify as accredited. So now my options are significantly wider, and I don't have to only invest with people that I've known for a very long time. So
yeah. Thank you for tying your personal story with the sophisticated investor definition and the accredited investor.
Mm-hmm.
I think that really illustrates the value of qualifying as an accredited investor.
Yep.
And it takes time. You've been working on investments as well as growing your businesses to get to that point, and that's the journey that we've all gone through.
Yeah. And I went on some paths of trying to start my own businesses and varying successes of these offshoots of other things I wanted to do. One of my latest ventures, I finally kind of wound down. I kind of finally have the numbers, and I was like, okay, I think I spent about 2.5 years of my life messing with this. And where did I net out at? And I think I netted out about a negative $10,000. And so I was telling my wife that, and she was like, rolling her eyes at me. And thankfully, we're at a spot where that kind of loss isn't a big deal for us. But it's like, man, what if I hadn't spent all that time and all that effort trying to do something myself, and rather than spending $50, $60, $70,000 over the course of those 3 years, what if I just invested that $50,000 could be 100 now. But because I was trying to do stuff myself and I didn't do it well, it's negative $10,000.
Yeah, but there's no counterfactual, right?
Correct.
It
No
might have
guarantee.
gone well. And furthermore, during that process, you've grown a lot and learned a lot about building a business. Do you mind sharing what that was, this venture?
Yeah, this is, I got a buddy who got me into mining cryptocurrencies, right? So I wasn't doing Bitcoin mining because that's a little bit different, and I'm not a technical expert, so I'll sound like an idiot if I try to technically explain everything. But I was mining Ethereum, which you could do with basically a high-powered gaming graphics card, like a computer gaming graphics card. And shortly after I built this super high-end, expensive computer, it was like a $20,000 computer, the way it was built out. It was essentially like a high-end computer with 5 of the most expensive gaming graphic cards you could buy attached to it. Like 6 months later, and I was getting a return. There was a good thing going, but that's when crypto market crashed, and then the way Ethereum worked, like the algorithm, quote unquote, it changed. So you didn't earn Ethereum by mining anymore. You earned it by like having it and what they call like staking it, which I didn't have much. So I couldn't make money that way. So then we were like, well, how else do we make money with these computers if mining cryptocurrencies doesn't work? So then I had a buddy who actually showed me a way that you could rent your GPU computing power to other people who wanted to use that high-end computing power. And so that started working, but our systems weren't the best at that point. So I doubled down and bought the newest and latest, greatest technology. So I spent another $18,000 on a second computer, which did actually, that computer was turning, $1,000 a month profit for me for a while. That's where I made up most of my expense. But man, technology just accelerates so fast. Even the high-end stuff becomes not the latest and greatest within 1 or 2 years. The market became saturated. Value started dropping. I'm not a technical guy in that end, and it was just a lot of effort, a lot of trial and error, and realized that I was actually taking away from my real earning potential by trying to make this passive money work, because I was having to work so hard to make the passive money. So that's one of those. I've also, I got into like cash offer advertising for like real estate flips, which if anybody familiar with, single family investing, which is what a lot of people do. I was like, hey, I'm a real estate broker. I've flipped homes before. I've had some success. I should start advertising on Google that I will buy your house cash. And man, that's a totally different ball game. Totally
That's
different than
wholesaling.
just
All
that.
right.
Well, no, I was actually going to buy them cash and flip them. So like
Okay.
I was actually going to be the guy who did that. And I started that in early 2022. And if anyone's familiar or watched the real estate market kind of flipped in mid 2022.
Yep.
So I bought one house early that hooked me. It was like that little taste of the drug that was like, oh, this
Yeah.
works. Well, I think I spent about $50,000 in advertising. And then I lost $20,000 on that first flip. So ended up, I was probably about a net negative $70,000 loss on that one. And I was like, maybe I should not do this anymore. And that's maybe I should have powered through and I'd have a totally different business model and I'd be doing that full time. But it was just something I was trying to bolt on to my core business model that was distracting me.
Got it. Got it. I have a couple of friends, business partners who run very significant wholesaling operations here in DFW,
Mm-hmm.
and they do a ton of volume. One of them I spoke with recently. Shout out Hunter Jarvis, my business partner and friend. But he said his sales guys make. Well, I won't. Probably shouldn't have shouted out his name, but they make a lot of money. Like,
Yeah.
yeah. And these are the
Those
sales
guys
guys
who are
who
good,
work
they can
for
make
him.
6 figures plus. Yeah.
Yeah, multiple six figures. Yeah. So it just goes to show like there's so many ways to make money. But the two guys that I know that excel at this are very skilled operators.
Yeah.
And that business is particularly difficult because it requires constant shifting. You got to shuck and jive constantly. The market today, the dynamics are very different from 2022, and so they've adapted their businesses. But anyway, that was very interesting that you tried that. I did
and
a
it's
little bit of
really, it's
wholesaling myself.
correct. Yeah. And man, it's like really operating in what I've had kind of a mentor call like your zone of genius. Like that's where you're successful, right? It's not that one business model is worse than another. I have a good buddy and he's doing the AI computer stuff. He's doing well. I know people who are wholesalers and they kill it. And neither of those things are my zone of genius, right?
Yeah.
My zone of genius really has been in the more relational side of businesses as opposed to the technical side or whatever you want to call wholesaling and flipping, right? Like it's not, I mean, you can help people, but that's not a relational business. That's a very transactional. That's very
Yes.
much grinding the phones, having those conversations repeatedly, getting yelled at, getting told to F off, all that stuff. And then you get the deal. And then you get these big deals here and there. So
Yeah.
not the way I'm wired.
I hear you. Yeah. Guess what? I'm not a wholesaler anymore. Same reason,
Yeah.
Jared. So I failed pretty miserably at that. So I want our audience to understand, to learn from you, like what's Clotine Capital? What do you guys do there? I know you have partners. I know Dan, I met him in Florida a few months ago when we were out there. So tell us about that business.
Yeah. Dan is actually the one that I kind of got that operating in your zone of genius in, because what Clotine is, I mean, we're a fund, right? And people are familiar with funds. Where we get into a little bit of a niche in the fund world is kind of like I think what people, if you've dove into it, you might be familiar with the term like a customizable fund. So we have different offerings inside the fund, and you can choose what your money participates in. So rather than giving your money to like a hedge fund manager who's going to take your money and do whatever they want with it, we have to have deals that our investors want to participate in. And then, they invest their money in those specific deals. So, right now we have a couple of options ranging from like residential development to hard money lending. And so and this is in the single family like segment. So first position liens on property, hazard insurance, title policies, all that stuff. So super safe, straight cash flow versus no cash flow, but higher returns based on, future developed value, right? But the investor who is looking for the development deal, they may not care about cash flow. Maybe they are the high income earner that doesn't need extra cash flow. And so they're looking to grow their net worth as fast as possible, even if they don't see cash flow. And on the other end of the spectrum, I had a client I'm emailing with today who they're retired. They have kind of like they have their fixed assets and they are living off cash flow. So a development deal is not for them. And a blended deal where if they were to invest and their money was like split between the two, that wouldn't even be good for them. Right.
Yeah.
So, we are allowing our investors to pick what their money participates in, and their money only participates in that deal. So for the good and the bad, but really it's meant to benefit the investor.
Okay. So
And
that was going to be my question. So the very growth oriented deal versus the income oriented, those are separate funds under the Clotine umbrella.
So it's actually, they're separate entities owned by the fund. So the money and that's really one of the reasons it was done this way and why customizable funds are kind of coming into, I don't know, a little bit of a highlight right now, is because, if you've had many conversations with, I know you've had a ton of conversations with investors, but many conversations around private placement memorandums and the massive amount of documentation that goes into, an investor choosing to invest. And all that information is necessary. Like, it's good, but it's also overwhelming to an investor who maybe not as experienced. So if you were to invest in separate funds, you're having to go through an 80, 100, 150 page PPM per fund. When you structure it the way we have a single PPM, so a single document that kind of gives the overarching umbrella of what the fund does and how it operates. And then when an investor decides what they want to invest in, there's like a 2-page, we call it a deal memo. You could call it a term sheet, something that outlines the specific financials of that specific deal. And that way it's super simple to understand once they've read the PPM, right? So the PPM covers the governing and the all the other stuff, the governing models, who can do this, what's the legal rights of that, all that stuff covered by the PPM. And that's important, but that's typically not what people are really trying to make sure they understand. It's, what's the hold period? What's the return? What are we actually investing in? What's the actual thing? And what are the parameters around that? So they can start doing some of their own due diligence around risk and their comfort level.
So it is possible to invest in just one of those asset classes?
Yes.
Okay.
Yes.
Got it. Do you have any other asset classes within Clotine?
Yeah, we have a really interesting one, and it's new. And what it is, we are partnering with someone who's offering a really great tax strategy for super high income earners. So if you're in that 37+% tax bracket, and I say plus because of state income taxes, I know federal 37% is the top right now, but there's a company out there that does some really creative things to help those income earners reduce their tax liability, almost in a way that's you actually get an ROI, right? So maybe you're going to spend $100,000, but you're going to get at the end of the day, if the math works out appropriately, you're going to get $150,000 tax reduction, not a credit, but your tax bill actually is going to be reduced $150K. All right, so that's a 50% ROI, right?
Mm-hmm.
The problem is the outlay of that money happens 1 year and the tax benefit happens the second year.
Got it.
And that's not always how people want their money to work. So what we have partnered with, so what we do is we will actually give a loan to that person that needs to outlay let's say $100,000 in 2025. And that's a 11 or 10 to 12%, return. Now that is the difference in something like this is that there's not a real estate that's securing it. You're basically kind of getting a personal guarantee from someone who makes a ton of money, because that way they can, get their $100,000 purchase, but they only put $10,000 or $12,000 down. And then a year and a half later, the next tax year, they're going to pay the loan back they got, right?
Mm-hmm.
And then they're going to get their tax benefit. Yep. So they're going to be out of pocket $10,000, $15,000 1 year. And the next year they're getting a $50,000, gain when everything's netted out. So
got it.
It's a really interesting, it is all IRS compliant. It might be one of those loopholes that they end up closing at some point. but it's like the IRS is like, this is actually too good. It's kind of like anything that's any kind of medicine that works, they want to regulate it, you know?
Mm-hmm.
So that's an interesting one. Right now, those are our three options. So we've got kind of
Got
like a traditional debt fund inside the real estate world, which is hard money lending. We have development. Then we have something kind of in the middle. It's an increased income fund that with just some nuances to that.
Got it. Very interesting. I've not heard of anything like that. I'm curious what the mechanism is by which they achieve these tax savings.
Yeah, I mean, I'll give you the overview. Again, I'm not an expert in this. We don't actually offer the tax saving model.
Right. You're just doing the
It's the other
finance.
company, but I had to understand it enough to talk about it. So what they're essentially doing is, when a agricultural manufacturer, maybe it's like some sort of agricultural seeds. So seeds that produce food, not like flower seeds. They have their year, they have leftover seeds that they're going to have to either dispose of or do something. This company can facilitate buying those at a very, very steep discount over what would be considered market value. So maybe they're buying seeds at 25% of what the market value is approximately. So 75% discount.
Okay.
So if you buy those, you buy $100,000 worth of seeds, right? That's actually fair market value might be 400 if you were to get full value for those. If you hold that for over a year, think about it like capital gains versus long-term capital gains. You hold it for over a year. If you get the value assessed by like a third-party appraiser, for lack of a better word, he can say, hey, the fair market value of these seeds that you bought over a year ago is actually $400,000.
Mm-hmm.
And then they can be donated to, qualified nonprofits that are, and I think they donate them to like nonprofits that are, helping with food shortages in Africa,
Got
for
it.
lack of a better word. So you're spending $100,000, but then you're donating $400,000 worth of assets. But if you didn't hold it for a year, you couldn't get the difference. You could only get the donated value of the cost, like cost value versus market value. So by holding it for over a year, you can get the fair market value of the asset. So you spend $100,000 and then you get a $400,000 tax write-off. That's why this only makes sense for the super high income earners, because you need more than a 25% tax bracket for this to make sense.
Got
But
it.
if you're in California and you're paying 37% federal and I don't know, it's like
13%, I
10 or
believe.
13.
Oh,
Yeah, I
yeah.
think some of the examples they gave were someone who could have a 50% tax bracket and how that would work for them.
Got it. All right. So those of you who are business owners or
If
high
you're in the
income
50%
earning
tax
professionals
bracket, yeah.
in New York and New Jersey and California, talk to
Yeah,
Jared.
and I'm happy to connect someone if they want to talk with these people. Again, I don't offer it. It's not through the fund, but happy to connect someone with them if they're like, "Oh my gosh, that sounds interesting," and let them do their own due diligence, right?
Yeah. Right. Got it. All right. Now you had mentioned earlier some pretty interesting deals that you are invested in as an LP. Like I think you said pharmaceuticals and a couple others that caught my attention. Can you share what those experiences have been like? Tell us a little bit
Yeah.
about those deals.
Yeah, and I was like, man, maybe I shouldn't tell everyone every bad deal I've done. But honestly, I think that's the interesting stuff, right? Like I've been in good deals. I'm a good business guy. It's just some of the deals I've done, it's like, okay, that doesn't work. I've learned my lesson. And so, man, a couple of the deals I'm in right now. I'm gonna tell you my last failure before I go on from there. Had some people that I know and I trust and I like them, right? And I still like them. I don't blame them for this, but they introduced me to a investment in the world of pickleball, and it was called the Pickleball Club. And this company, what they were planning to do and trying to do was develop these basically country club style experiences for pickleball, where rather than going there and playing golf and then hanging out at the bar and having a little deli and all that stuff for golf, it was for pickleball. So you'd have a big basically kind of warehouse style building. you might have 6 or 8 courts inside the building, air conditioned. You'd have a food court. You'd have like maybe like an upper deck area to watch. You might have a couple of outdoor courts as well, but these would be membership based. It's technically private clubs, and membership might be $250 a month, right? As opposed to whatever golf clubs are.
Yeah.
And these were in Florida, which, okay, we got a bunch of old people in Florida, a bunch of retired people with money. Okay, that makes sense. They already had one club in operation. It seemed the business model seemed to be working well. They had, 3 to 5 more in various stages of production. All seemed to make sense. And I was like, okay, that's interesting. I know pickleball's getting huge. And then I was like, and this is kind of what I said. It's like, at the end of the day, if it all kind of goes to crap, they own the real estate and they're building the buildings. They're not like leasing stuff. So I think if it all kind of failed and pickleball went down the drain, then I think they could sell their money, and I think that, or sell their assets, their real property and their buildings. And I think that my investment would probably be safe, and I think probably I'd get my money back. So let's do it. So, and they had a pretty high minimum. And so my friends who introduced us were setting up an SPV, a single purpose vehicle or special purpose vehicle, whatever you want to call it, where a bunch of people could kind of put less than the minimum together and then go in and invest as a unit. So we did that, and it wasn't too much longer that we found out that there had been some, I'm going to say, financial irregularities. I don't know all of it. But basically the business model wasn't going as well as maybe had been kind of presented. Some of the sponsors had been like lending the company personal money and then charging the company pretty significant fees on the money they lent the company. And then some other stuff. And so currently it looks like that investment is not going to go well, and they are liquidating some of their assets. So we will see how much money I end up getting back out of that deal.
Oh God.
Yeah. So, it's like, I probably moved too quick. I probably didn't do enough due diligence. I probably relied too much on maybe the trust I had in the people that brought me the deal, that they did all the due diligence they should have done. Right. And it's not their fault. They didn't mislead me in any way, but I just said, okay, well, if he's already invested in it and he's bringing it to me, it's gotta be a good deal,
Yeah.
So, doing your own due diligence is something you should always do, even if you trust the people who are already invested.
Yeah. Well, so I relate to that. I know I've shared with you a story that is essentially exactly that, just different operator, different asset class. So this is how we learn by having these kinds of learning experiences.
Yeah, exactly. And really, and a lot of times you got to look at this and be like, hey, I guess this was my education. Like, this was the fee I paid to learn the lesson I needed to learn. So as long as you just need to make sure you're learning something and you're not just repeating these things that are causing you to lose money, right?
Yeah.
Nobody's ever going to have a perfect investment track record. No syndicator, no passive investor. Like, I know a lot of good passive, good investors, very successful, long track record of making good decisions, and they're in deals that are struggling right now. So, but some of my other deals that I'm really interested in, that I like, and I kind of like, it's funny. I say that I am risk averse, and then I realize my actual actions might show that I'm not very risk averse. So, or maybe it's all how I kind of compare it in my head. But so one, I invested in a title company where I practice real estate. That seemed to make a lot of sense to me. We had a lot of other like kind of higher end producers. So real estate agents, real estate brokers who did good business, had someone come to us, say, hey, if we get a bunch of you guys together, we can start a title company. Y'all can provide the initial level of business that will support the business, and then we can grow from there. So that one's good. That one's been in operation since like middle of 23, maybe. And I did the math just this week. And it's been a slow tick up in our kind of our distributions.
Good.
We've gotten distributions most months. We are, let's see, this, as of like June, we're at about a gross 53% return on our money in about 2 years, right? And this year alone looks like it could be about a 43% return.
Oh, wow.
So our velocity is increasing there. So that's good. Unfortunately, the way that's structured is, unless there was like a big sale, there's not going to be a huge payout, right? So I'm making somewhere between $1,000 to $2,000 a month on that one. That's a good one. I like
But
that.
getting
That's
your
some good cash
principal
flow.
back in 3 years is incredible.
Correct.
Yeah.
Absolutely. And from there, it's all
It's
gravy,
all
right?
gravy. Yeah. Amazing.
So I recently invested in a company, essentially a kind of like an agricultural equipment manufacturing company, and I invested through um, a mechanism I was unfamiliar with, had to do some due diligence on it. It's not the best mechanism normally. It's a safe note, a simple agreement for future equity. So most of the time, they're not great deals. This one was an okay deal, like an okay structure, right? But what they were doing, and they were already in production, they were already getting contracts from federal agencies. They're essentially producing firefighting equipment to put on skid steers so that firefighters can go into forests to put out fires and drive around, or into fields where like their fire trucks and hoses can't get to. And then the modifications for those is like, okay, well, you could turn those into, fertilizer delivery systems or all sorts of other stuff that you can modify. Essentially, what it started out as firefighting equipment that was mounted to agricultural machines.
Got it.
So
You know,
that one.
there is a guy named Chris Corner who I need to reach out to him. He's a serial entrepreneur, and he's local to us, or at least to me.
Okay.
I live in McKinney. He appears to live in like Allen or Fairview or something. But in any case, he sends out a newsletter every week that's really just chock full of amazing entrepreneurial information.
Mm.
But one that reminded me is that you reminded me of by mentioning the skid steer is some guy created a brush clearing business and just immediately right out of the gates just started killing it because his market just had a
Didn't
shortage.
have it. I saw something about that. Yeah, like just, I mean, the guy's on track for like $1 million in revenue, like year one or something. Like just
Yeah.
absolutely bonkers. So, yeah, so I've done that. I've invested in another multifamily syndication in the Carolinas through some guys I know who've been doing well in the current market, right? They've had stuff go full cycle, exit, even in the market we're in, which is, if you're looking at multifamily syndications and syndicators, that's just, you just got to do a lot of extra due diligence right now.
Yeah.
So,
there's a lot
and then a
of
pharmaceutical one that it's either going to be 0 or it's going to be like 100x. So who knows on that one?
so more like a venture deal then, maybe on the
More like venture capital. Yeah. I mean, the guys who were doing it were the actual, like, I'll say scientists. I don't know what their technical term is, but they were in like second stage human trials with this delivery mechanism that could be applied to, drugs that are very addictive, to reduce the ability to abuse the drugs, right? And reduce
wow.
shelf life so that less people, can get a hold of grandma's pills 6 years after she's done using them. So that's something that I thought was really interesting. I'm not a huge fan of the pharmaceutical industry, so I almost kind of checked out when he initially started talking about it. But this guy, he likes to invest for impact, but also, like impact, but it has to make sense, like financially, right? So when I found out that it actually wasn't a new drug, it was a way to prevent people from abusing drugs, and it would set up so that hopefully the pharmaceutical industry would like that by reducing shelf life. That seems super interesting to me. So that one will get approved and probably go super big, or it will never see the light of day and I will lose every penny.
Yeah.
But for younger guys, that's probably should be a small percentage of your portfolio, right?
Yeah.
For me, that was like $35,000.
Yeah.
So if I lose it, it's not the biggest loss I've ever had. But if it's 100x return, that's a huge deal, right? Now, what's the percentage of that? Pretty low, probably. If it does see the light of day, it's probably gonna be somewhere much closer to maybe a 10x, and then it's still a reasonable investment.
Yeah. The takeaway from that for our listeners is you always got to think of these things in terms of the risk and reward spectrum. Like where does this offering or this deal sit in that? This pharmaceutical venture type deal is a high risk, high reward.
Yeah, and then how does that profile, not just are you comfortable with it, like from a, is the reward commensurate with the risk, but like does it make sense for your investor profile, right?
Right.
Like my parents probably not, right?
Yeah.
65-year-olds shouldn't be investing in stuff that has a high probability of total failure.
Yeah.
Uh, you know,
100%.
don't want to make decisions for other people, but
Yeah.
that would be a pretty strong guess.
Yeah. Yeah. You're exactly right. It's about how it fits into what you're looking for as an investor and
Yeah.
where does this deal sit in the risk reward spectrum. So really good stuff, man. Thank you for sharing all of that. I think this discussion opens up people's eyes to understanding, oh man, like I could be like this guy Jared, invest in a bunch of really
Yeah.
interesting things, some of which are directly complementary to his day job, so to speak, in real
Yeah.
estate, and others that are completely separate from that, and yet present some sort of a compelling investment opportunity.
Yeah, man, I think, and something you said you wanted to touch on is like building on that, right? Like I was trying to build all these businesses myself and realized I wasn't actually very good at a lot of the things I wanted to do. What I was good at was being a real estate broker, right? And so I got to my accredited status by producing a really good income for myself. I don't have bukus and bukus and bukus of net worth like people oftentimes think of these investors have. But there are guys who are listening to this. They're probably doctors. They're probably attorneys, or they own their own small business. And like, well, I'm doing really well in this, but what else could I be doing to grow my net worth? I've decided, even though like I'm actively in real estate, I've decided to like do what I'm really good at, which is relationships, and then also invest in other people's deals, right? So like I invest in Clotine, which is the deal in the fund that I'm associated with. I run my own real estate business, and then I also invest with other people, right?
Yep.
And so if you've got the doctors, maybe they use some of their knowledge to invest in medical related funds. That would make sense. You get an attorney, maybe they invest in businesses. Maybe they're like a business attorney. Um,
Yep.
and so like you can still use your personal experience to help you invest better,
Mm-hmm.
even if you are, not this big experienced investor or not going to go and, be a syndicator, right? Like that's not the best option for everybody.
Right. Right. Absolutely. That, and it takes somebody with some experience and perhaps some challenge and or pain to be able to make the statement that you just made. You know,
Yeah, at one point I was trying to run like 6 businesses at once and realized I was not doing any of them well, right? And so I literally had told people, I will make more money keeping all of my money in my own control. And I lost a good amount of money doing that. So, that's where even with like the fund in operating your zone of genius, like I work with investors to bring them on board and help them understand what's happening and developing the relationships. And then someone else is the one actually running the investment.
right.
Right. So it frees them up to not deal with investor questions all the time and deal with these, I'm gonna say kind of pejorative, like needy relationships, right? But it's a justified need. But that lets them run their business full time. And I get to have the relationships with the investors and not be bogged down by the day-to-day of which loan do I approve today. Right. And so, yes, operating your zone of genius, figuring out like where you can leverage. Maybe it's leveraging your money, maybe it's leveraging your time or your expertise. But yes, I have had areas where I thought I could do it best by myself, and I realized I could not.
Yeah. Yeah. Very wise words there. Sometimes we need to recognize what our lane is before we can even stay in it or decide to stay in it.
I like that.
Yeah.
Yes, I like
Yeah.
that. Some people do not know their lane, and sometimes I'm still trying to figure that out.
Yeah. And I am too in a lot of ways. So,
Yeah.
wow, amazing conversation, man. Thank you, Jared. Any last parting words or advice that you might have for our audience here?
Oh man, I'd say just start. I don't have anything that's super crazy, but like I'm a guy that I've always struggled with perfection, and I've gotten to where I tell myself progress over perfection, right? So just start something. Start the education, start having conversations, start meeting people. whatever that looks like, just start like and move forward and just do that.
Yeah, absolutely. And I will add that the way that you start is typically through joining some sort of a community. So for Jared and for I, independently, we were both in real estate mentorship communities, but like what we're doing here at Beyond Stocks is trying to create a community to open people's eyes to the fact that you can invest in a pharmaceutical company or a title company or a variety of different private deals. But you do have to look for them, and you do have to make relationships with people in order to even know about these deals. So with that, thank you very much, Jared Benson, everybody. Where can people reach you or learn more about Clotine?
Yeah. So clotinecapital.com is going to be a good place to do it. You can find me, Jared Benson, on LinkedIn. And I'm actually starting a podcast, probably, I mean, maybe kind of similar to yours, you know? So that's going to be the Accredited Investor Edge. If they want to, you know, if they want to listen to me talk more with other people, maybe we can get some guests back and forth and get some extra conversation, but that'll be on anywhere you get podcast, probably starting tomorrow.
Okay. Amazing. All right. And what's the name of your podcast?
Accredited Investor Edge. So really trying to help these individuals, you know, get that extra little bit of knowledge that they need to, you know, a small improvement on their portfolio can make big differences over time. That's kind of where I got the edge side of that from.
You got it. All right, everybody, check it out. accreditedinvestoredge.com. Thanks again, Jared Benson, and everybody have a great rest of your day.
Awesome. Thanks, Chihiro.